As we continue our deep dive into support and resistance, it's important to understand how these levels can be used to manage risk in your trading. One of your key tools for risk management is the stop loss order. A stop loss order is an instruction to your broker or platform to close out a trade at a specific price level, limiting your potential losses if the market moves against your position. By strategically placing these orders in relation to support and resistance levels, you can help protect your capital and maintain a favorable risk-reward ratio. Let's take a look at this example. Here we have a potential buy setup on the daily chart of Apple. Here, our buy point is on a breakout above horizontal price resistance. Since the breakout causes prior resistance to become new support, we manage risk by placing a stop just below support of the prior swing low. This placement allows for some short-term price movement while still limiting our downside risk. Now, as we scroll through the price history, notice how that breakout entry kicked off a steady new uptrend that held perfectly at support of the 20-day exponential moving average as the price rallied steadily higher. We'll learn all about moving averages in the next lesson. The exact distance you place your stop loss order from the support or resistance level depends on factors such as the asset's volatility, your personal risk tolerance, and your overall trading strategy. But as a general rule, when setting your stop below a support level, you want to make sure you give the price a bit of wiggle room to allow for natural market movements without stopping out of a trade too soon. However, it's also crucial not to place your stop loss order too far below a support level. Doing so can lead to larger losses if the trade goes against you. The key is to strike an ideal balance between allowing for short-term market fluctuations and protecting your capital. By the way, when alerting you to a new swing trade entry in the MTG Tribe chat room, we always provide you with our exact entry and stop prices for our strategy. This continually reinforces the entry and stop placement techniques you're learning in this course. Now in this example, we see that our stop was quickly triggered after the price broke firmly through support. Since the price continued much lower, notice how the stop limited our loss and freed up capital to look for the next potential winning trade. Your absolute number one goal as a trader must always be live to fight another day, and a proper stop placement strategy will always enable you to do so. As you progress through your course, you'll learn more about specific stop placement strategies and risk management principles. We'll dive deeper into these concepts in Module 5, where we discuss the principles of money management and how to protect your capital in various market conditions. Keep an eye out for that upcoming module. For now, simply focus on understanding the general concept of using support and resistance levels as a guide for placing stop-loss orders. By incorporating this knowledge into your trading plan, you'll be better equipped to manage risk and preserve your capital no matter what the market throws at you. Remember, successful trading is not just about finding profitable trade setups. It's also about effectively managing risk. As you develop your skills in stop placement and risk management, you'll be taking major steps towards becoming a well-rounded, disciplined trader. At Morpheus Trading Academy, we emphasize the importance of trading what you see, not what you think. This principle applies not only to identifying potential trade setups, but also to managing risk. By placing stop-loss orders based on the actual price action and levels of support and resistance, rather than emotional attachment or random levels, you can make more objective and effective risk management decisions. Remember, mastering support and resistance is a journey, and each lesson brings you one step closer to becoming a proficient and successful swing trader.